This is capital collapse. Gold just moved $311 in a single session. That's the largest one-day dollar gain since 2008, a $2 trillion shift in market cap. Roughly the entire value of Amazon erased or created in 6 hours, depending on which side you were on. No CEO announcement, no earnings call, no Fed decision. Just the oldest asset on Earth reminding everyone it's still here. And if you missed this move or got caught on the wrong side, you need to understand what just happened and what comes next. If you're following Capital Collapse, hit subscribe and drop a comment with where you think gold closes by end of week. Are we going to 5,200 or pulling back to 4,900? I want to see what the community thinks. Let me show you the numbers. Gold opened around 4,950 and spiked to 5,261 intraday. That's a $311 gain. Currently trading around 5,100 as I'm recording this. Silver moved in sympathy, up 14% on the day. When gold, silver, and copper all pump together like this, it's not speculation. It's the market repricing what money actually is. Now here's what I'm watching. Did we just break out above the 5,000 psychological level for good? Or is this a bull trap that fails and sends us back to 4,700? The answer depends on a few key technical levels that I'm going to break down right now. First, let's talk about what triggered this move because the timing matters. This happened during Asian trading hours. Shanghai was open, London was starting to come online, and right as this rally started, reports were breaking about escalating geopolitical tensions, U.S. conflict with Iran making headlines, uncertainty spiking. When geopolitical risk explodes, gold is the immediate safe haven. Capital flows out of everything else and into gold. That's what we saw. But here's the tricky part. The initial reaction to war or major conflict is often risk-off across the board. Everything sells first. Cash is king. Then after the dust settles, gold gets the sustained bid. So the question is, was this the initial panic buy that gets sold once clarity comes? Or is this the beginning of a sustained move higher because the geopolitical risk is real and lasting? I don't know yet. But I can tell you what the chart says we need to see. Here's the bull case. We broke above 5,000 with conviction. We touched 5,261 intraday. That's a decisive move. If we can hold above 5,000 on the daily close for the next few sessions, that confirms this level flipped from resistance to support. And if that happens, the next target is 5,200, then 5,500. The psychological levels in gold matter. 5,000 was massive resistance. We tested it multiple times over the last few weeks and got rejected. Now we're above it. If it holds, bulls are in full control. The path of least resistance is higher. Also, volume matters. We saw huge volume on this move. That's not a low liquidity spike that gets reversed, and that's real buyers stepping in. When you get breakouts on heavy volume, they tend to stick. So from a technical standpoint, this looks bullish as long as we hold 5,000. Now here's the bear case because we have to look at both sides. First, we spiked to 5,261 and immediately pulled back to 5,100. That's a $160 rejection from the highs. When you get that kind of intraday reversal, it's a warning. It means sellers are waiting at higher levels. Bulls pushed, bears pushed back. Second, this move was driven by geopolitical fear, and fear-driven rallies are often short-lived. Once the headlines calm down, once the initial panic subsides, safe haven bids reverse. We've seen this pattern before. Spike on war news, fade over the next week. Third, if we can't hold above 5,000, if we close a daily candle below it, that's a failed breakout. And failed breakouts often lead to sharp reversals. If we break back below 5,000 and start testing 4,900, that opens the door to retest 4,700 or lower. Fourth, bond yields are spiking. The U.S. 10-year Treasury yield is approaching the highest level since August 2025. When real yields rise, gold gets pressured. Higher yields mean opportunity cost for holding non-yielding assets like gold. If yields keep climbing, that's a headwind for gold even with geopolitical risk. So that's the bear case. Intraday rejection at 5,261. Fear-driven rally that could fade. Failed breakout risk if we drop below 5,000. Bond, yields rising as a headwind. Now let me show you the key levels I'm watching this week. If we hold above 5,000 and push higher, I'm watching 5,200. That's the next major resistance. If we break 5,200 and hold above it, then 5,500 is in play. And if we somehow get above 5,500, we're in price discovery mode heading towards 6,000. But if we fail to hold 5,000, if we close below it on the daily chart, I'm watching 4,900. That's the first support. If 4,900 breaks, next stop is 4,700. And if 4,700 fails, we're retesting the lows around 4,400. The key inflection point is 5,000. Above it, bulls are in control. Below it, bears take over. It's that simple. So I'm watching the daily closes this week. If we get 3 consecutive daily closes above 5,000, that's confirmation. The breakout is real. If we can't hold it and drop back below, this was a fake out. Time frames matter here. On the 4-hour chart, we're in a strong uptrend. On the daily, we just broke a major resistance level. On the weekly, we're still in a massive bull market that started back in 2020, so your perspective depends on your trading time frame. If you're a day trader, you're playing the intraday volatility between 5,000 and 5,200. If you're a swing trader, you're holding above 5,000 with a stop below 4,900. If you're a position trader, you're zoomed out looking at the long-term trend, and this is just noise. Now let me talk about what's happening in the physical market because this matters. During the $311 move in paper gold, what happened to physical? Dealers are reporting that premiums are stable. There's no panic buying at retail yet. This isn't a physical demand-driven rally. This is a paper market reaction to geopolitical headlines. That tells you something. If this were a structural move driven by real physical demand, you'd see premiums spiking. You'd see dealers running out of inventory. You'd see mints getting overwhelmed. We're not seeing that yet. This is futures and ETF buying, not physical accumulation. So the sustainability of this rally depends on whether physical demand catches up. If retail and institutional buyers start accumulating physical gold at these levels, that puts a floor under the price. But if this is purely paper speculation reacting to headlines, it can reverse just as fast. Here's what I'm also watching. The gold to silver ratio. During today's move, silver outperformed gold on a percentage basis. Silver was up 14%, gold was up 6%. When silver outperforms like that, it's a risk-on signal within the precious metals complex. It means traders are chasing the higher beta play. That's actually bullish for the overall metals market. It means conviction is building, but it also means volatility is increasing. When silver moves 14% in a day, that's not stable price action. That's speculation and momentum trading. So we're in a high volatility environment right now. Let me also talk about central banks because this is important context. Central banks have been buying gold for 33 consecutive months. They bought 328 tons in the most recent quarter. Poland bought 102 tons. Kazakhstan bought 57 tons. This is a structural bid under the market that doesn't care about daily price swings. So while paper traders are reacting to headlines and technical levels, central banks are just accumulating. They're not trying to time the market. They're diversifying away from the dollar. And that structural demand puts a long-term floor under gold even if we get short-term pullbacks. Now here's the connection to what's happening in other markets. Bitcoin just broke below 74,000 for the first time since April 2025. The S&P 500 is down. The NASDAQ is down. Risk-off is spreading across all asset classes. When that happens, gold usually benefits. But it's not automatic. Sometimes everything sells together first before gold decouples. So we're at a critical moment. Is gold decoupling from risk assets and acting as a true safe haven? Or is it going to get dragged down with everything else in a broad liquidation? The next few days will tell us. Here's what makes this tricky. The geopolitical situation is fluid. Headlines can change by the hour. What looks like escalation today could de-escalate tomorrow. And markets react violently to those changes. So if you're trading this on leverage, understand that the volatility can wipe out positions in minutes. Let me give you 3 key takeaways. Number 1, gold just posted its largest one-day gain since 2008, $311 in a single session. We broke above 5,000 and touched 5,261 before pulling back. The key level to watch is 5,000. If we hold above it on daily closes, next targets are 5,200 and 5,500. If we fail and drop below it, we're testing 4,900 and 4,700. Number 2, this move was driven by geopolitical fear and safe haven flows. It's not physical demand yet. Premiums are stable. Dealers aren't overwhelmed. This is a paper market reaction. For the rally to sustain, physical buyers need to step in and validate these levels. If they don't, this could reverse. Good. Number 3, we're in a high volatility environment. Silver up 14%, Bitcoin down below 74K, bond yields spiking, risk off spreading. Everything is moving fast. The technical levels matter, but geopolitical headlines can override any chart pattern. So if you're trading this, understand the risks. Use stops. Don't over leverage. Plan for both scenarios. Now I want to hear from you. Do you think we hold 5,000 and push to 5,200, or do we fail here and retest 4,900? Drop your price target for gold by end of week in the comments. And tell me, are you buying this breakout or waiting for a pullback? Subscribe to Capital Collapse if you want daily technical analysis like this. I track the levels, the volume, the physical market, and the macro catalysts. When key moves happen, you'll want to be in the loop. This is capital collapse. Gold at 5,100 after a $311 move, the largest gain since 2008. Now we find out if this is the start of a bigger leg higher or a bull trap that fails. The key level is 5,000. Watch the daily closes. That will tell you everything. This is not financial advice. This is not a trading signal. This is technical analysis for educational purposes. Do your own due diligence. Understand the risks. Geopolitical events are unpredictable. Markets can reverse in minutes. Never trade with money you can't afford to lose. And if you're using leverage, understand that volatility this extreme can liquidate positions before you can react. Trade with a plan. Manage your risk. And follow the levels, not the emotions. Capital collapse out.